So the next section is going to be talking about life from a corporate finance point of view. My name's Andy Killick and I oversee the deals and restructuring team. The areas we're going to cover today is really having an update on the transactions market, looking at the factors that are affecting valuations in current climate, and going into some of the detail in terms of the adjustments between the enterprise value for the trade of a business and the equity value that you actually get for the shares of the business. And then we'll look at some of the current factors affecting profitability, what you can perhaps do about them, and the impact on valuations. So first of all, let's start off looking at deal activity across the UK. From the graph, you can see on the right-hand side the tail off in deal activity we've seen of recent months, and the fact that that trend is continuing. You may have heard of it in the press, a lot of talk about large transactions being a lot quieter. In terms of that, certainly the SME market is continuing to be busy, but not quite at the same pace as it was. If we then look at things in the south perspective, the same pattern is followed, although the decline from the peak is even further, and in the far southwest, deal volumes are down about 50% compared to the prior year. So what does that really mean? Well, whilst there's activity levels that are still continuing, we're really seeing that it does depend on the quality of the business and how it's positioned in the marketplace. Because certainly our recent experience taking quite a lot of businesses to the market has actually been very positive. We've been careful how we've positioned them and making sure they're viewed very positively in terms of their future outlook, and trying to find synergistic purchases rather than somebody who's just looking to buy a business for the sake of it, as it were. As a result of that, there's quite a lot of market divergence, and for people who feel they may have got a profitable cash generative business, pick up on the comment about activity levels and therefore think that they're just going to continue. That's not necessarily the case. Sadly, you could have got a successful business, but in the current climate, nobody's interested at all, rather than actually just offering you a lower price. I think the other aspect in the market that continues to drive it and change it from years gone by is the amount of equity. There's a substantial amount available globally. A lot of funds have raised the money and therefore they are looking to deploy it. So they'll pay high prices for good quality assets they believe they can really take further forwards, but they'll have no interest in other assets and businesses whatsoever. We're therefore seeing that whilst on the front of it, you may feel that you're selling your business to another trade entity, another corporate, but so many of those are now backed by private equity. So the result is private equity is having more influence on transactions than people realise, either directly through their own funds or indirectly through buy and builds. There was one particular one we sold one business to 18 months ago, and since then we've sold another 5 businesses to them as they continue to mop up transactions in that particular sector. And that's a theme we're seeing right across many sectors. If private equity feel it's one where they can really add value, they will buy significant numbers of businesses to actually consolidate it and then look to sell it on in due course. So if we now look at what are the factors actually affecting those valuations, for trading entities, it continues to be the EBITDA, the earnings before interest, tax, depreciation and amortization. And whilst people may say, well, you know, the cost of debt's gone up and tax rates again have moved up, but by basing it on EBITDA, that doesn't count. No, I'm afraid it's not the case. The multiple will be affected as actually applying to the EBITDA, because from a pure equity interest, those costs are having a significant impact on valuations of the entity, even if not the actual trade itself. In terms of transactions, there is continuing the trend of more post heads of terms work, finalisation, negotiation, partly because buyers are trying to put in high prices to start with to get through a process, and then they'll look to use the tail end of it to try and actually reduce how much they pay. So if we want to explore some of those aspects in a little bit more detail, so many businesses will receive an offer on a cash-free, debt-free basis and normalised working capital. It's therefore quite reasonable to assume that cash is cash and debt is debt. And obviously from your point of view, working capital may be normal because you're so used to it. But no, that's not the situation. And how people actually define these items is crucial. But unfortunately, there is no accounting standard for transactions. As a result, these areas are very grey, and therefore there can be significant variation from what a buyer thinks is reasonable or what a friendly version of it by a seller. So let's look at an example in a bit more detail. So imagine we've got a business that somebody's offered £10 million for, again, assuming debt-free, cash-free, normalised working capital. The standard approach also is less corporation tax if that's outstanding from last year. So putting some examples in there, maybe there's 200,000 of sort of COVID-related loans. There's actually 2 million of surplus cash in there. And the working capital, you think by the time of completion will be better than it was because you may have been reducing stock holdings and things like that. Less the liability for tax for last year. So actually for selling the shares, you're hoping to receive nearer 12 million, 11.7 million. So those are the sort of standard bits. You then go over all the other ones, and you may have a few years ago put in an EMI scheme. And when you come to sell the business, the difference between the exercise price and what's actually been achieved is allowable against your tax charge. So imagine there's an exercise price at £1, but they're being sold for £10. That £9 can actually be used to reduce your tax. So as a result of that, you would want as sellers to actually have that as an additional value item. So that could give you, let's say in this case, 300,000 additional value. The reason why I said a buyer-friendly version may actually be 200,000 negative, because in the same way as you can see a benefit, a buyer may look at it the other way around and go, but hang on a minute, you've valued your property for the purposes of negotiation and the transaction. You want to get 2 million for it, but it's actually in your books at several hundred thousand. And if the buyer buys it in effect at 2 million and they sell it, they will have to pick up a chunky tax charge. So the buyer will say, well, if we're giving you the value for it, we want to take into account the tax liability associated with that as well. You can therefore see there are lots of other items that come into play here. So whether they will be relating to, you've got some leasehold properties and there are dilapidations on it. You may receive cash up front or payments in advance for particular things, in which case a buyer again will go, well, hang on a minute, that impacts on the cash. You may have got some bank loans in place that actually the buyer is saying, we don't want those, and there's a termination clause. You want your 2 million of surplus cash out to yourselves rather than having to dividend it out because of substantial difference in tax rates. And a buyer will go, well, yes, but we're having to pay stamp duty on that extra amount. So as you can see, there's a whole load of adjustments here. Then actually buyers and sellers will look at this differently. A recent example we had was where the buyers were trying to go for 3 million of adjustments. And as I said earlier, there's no standard approach. We negotiated that down to only 300,000. And partly the reason we accepted that, because our client said they still wanted to do the deal. They didn't want to frustrate the buyer too much. So that power of negotiation and what else you've got to actually stick to your guns is going to be key. So if we bring this all together back to the offer, so that 10 million less the debt all the way through, just at the bottom here, it demonstrates the impact of all of these adjustments and how different parties can view them in different ways. Are you getting less than 10 million compared to the 12 million you might have thought you would have been getting? That has a significant impact, and hence why knowing these factors, what you can do about it, having a synergistic purchaser and a competitive process will enable you to rebuff many of these particular points. So looking further forwards, what have we got the factors affecting profitability and valuations really? There are a lot of factors people are talking about at the moment in the press in terms of whether it's economic, interest rates, tax, etc. And really, there's not a lot you can do about these apart from trying to minimize their impact. It's very difficult to actually use those to answer the profitability of your business going forwards. But when we talk about that and the information of what can you do as finance directors to really help your business and improve it going forwards, there are factors that are within your control. But a lot of those need an understanding beyond your management accounts of what actually is going on in your business. Was last month just because the numbers show it consistent with the prior month, or was it a totally different mixture of products, of margin by customer? Understanding that information and looking at alternatives to the way of doing things, instead of manufacturing some things in-house, should you subcontract them out? What's the impact with cash now, rather than just looking at the top of the P&L account? So you may hold some products and sell it for a profit, but actually by the time you've taken into account current interest rates, is that actually going to be in cash terms a loss? If you've got new products and services coming in, or those you've had recently, are you aware of what the return is on those? So these sorts of questions are not generally included in anybody's management accounts. And so more and more businesses we're finding they need to go into it in far more detail to enable them to make informed management decisions and to actually plan profitable growth rather than just continuing as they are and being at the whim of the market. So turning back to private equity, when we undertake due diligence for many private equity, they will want us to go into far more detail about a business before they acquire it, for two main reasons. One, to understand the risks associated with it. Is there a lot of dependency on particular products and high margins or particular customers? But then looking at it going forwards, they'll want to see how they can drive that profitability forwards. And so having that information is crucial. And we're seeing clients start to actually bring those strategies and that data into their business so that they can really help proactively to plan for the future and where the business should really focus, rather than actually merely the management accounts representing what happened last month. If you go to the extreme, the likes of Apple, so the largest company in the world, their turnover may be going down, but what they've been doing is analysing it in detail to see where they can actually drive more margin. So the gross profit margin and gross profit has actually been going up. So even a smaller business can have a higher profitability. With all the pressures going forwards over the next few years, this sort of area is something that FDs can really contribute to their business to help it go further forwards and more successfully. An example here I've put up is PowerBI, and if you're using this sort of data compared to management accounts, this is live. You're not having to wait a couple of weeks post month end to get your accounts. You can go in and interactively look at particular aspects and how they're changing the results, the dependency on particular bits of customers and products, what's happening to those, the implications of those, and the dependency. It's really a great way of understanding more about your business. And I'd recommend any FD to start looking at these sorts of programs of what's possible to see how they can help their business going forwards. So moving on from that, if we look ahead and say, well, what are the factors affecting valuations? And the reality is there are pages and pages I could have put up here, but I've just put a list of a variety of items here. We really want to pick up on some of the items at the bottom, the ESG, the synergies, cash generation, and X values, because these won't be the factors people are taking into account day to day, and they may not be affecting in terms of their business, in terms of the management accounts or how they perceive their own business. But from a buyer, from a funder's point of view, these factors will tend to have the most significant impacts on what the price might be, rather than just the valuation of the business. So the value of the business may be at one amount, but if there's an overseas purchaser desperate to get into the UK market or into your geography or into your customer base, the synergies will probably outweigh the issues from a valuation point of view. And we've had many examples in the current year where valuations along a particular route may have been 4 or 5 million, but we've sold businesses for 8 or 12 million in comparison, where we've got a synergistic purchaser. Working on several at the moment where the offers we've got from parties are significantly above a standard valuation because of the factors there and the benefit it can bring to the buyer, and ensuring the process brings those out so that the buyers can see that and how they can make money going forwards. In terms of an exit valuation, ironically, from a private equity point of view, that's the first thing they look at. And often we'll get asked right at the outset of working with them, what do they believe will be that exit valuation based upon our information, so they can work out how to drive that higher, how much to pay at the outset to really buy the business in the first place. So in summary, what I'd really say is there's a heck of a lot happening in the transaction market at the moment for quality businesses. And so how you position yourself is crucial if you are looking to do something. Many people who will be listening to this and in our presentation will say, I have no plans to do any transaction whatsoever. But the reality is, over the next year or so, a number of you will actually be involved in the transaction, whether it's planned, whether it's an approach, or whether it's for other reasons in terms of shareholder health or change in mindsets of what people want to do. So being aware of some of these factors will hopefully enable you to be more prepared. Even if you don't do a transaction, or in the meantime, having appropriate information to enable you to drive your own business forwards and the future opportunities to make sure that it's profitable and cash generative, I think is something that everybody can pick up on. And then one final bit is in terms of the valuation, to really understand that it may be the most important figure that's influencing all of you and your shareholders, but it's never actually talked about in your management accounts. So being aware of some of the factors that influence it hopefully will help you to have a successful future, whether that's in the short term, the medium term, or the long term. Thank you very much.